Hey investors, thank you for joining me. My name is Michael from Deep Value Returns on Seeking Alpha. Today I want to talk about ZoomInfo. ZoomInfo reported, I think it was towards the back end of last week, and I'm going to go through its results and talk about what it does and talk about its growth prospects. Then I'm going to talk about its free cash flow profile. So we've got a lot to get through here. Essentially, what ZoomInfo does, it allows subscribers access to its platform. The platform has information on organizations and professionals, okay? This allows marketing and sales team to shorten the cycle that they need to get the information that they require, updated, clean data, and being able to access whoever they need to access to drive that sales process. So by spending more time actually doing the sales, they're able to get more conversion from the leads. So it's it's a platform that just simplifies the sales process in total. We're going to go through and discuss that the stock is priced at approximately my own estimates of 55 times forward free cash flow, and that this is not actually as expensive as it sounds on the surface. So it's a high growth business. There's high margins. It's not that expensive. There's a lot to like here. Let's get in. So the stock is down. The stock's down a little bit, 30%. I know that this is sounds like a little bit, but depends on your perspective. If you've been in kind of invested in mid caps in the last 2-3 months, man, you've seen that 30% is nothing. You just kind of glance your eyes over this. And the results came out and it kind of fell 10% or so on the back of its results, but it's quickly found its floor. I think that investors recognize that this is a high quality business, and the thing with high quality business, you don't really get them in the bargain basement. Ultimately they go in expensive and they come out expensive, and that's it. It's just difficult to price these things to get them on the bargain basement, really. They talked about in their guidance, they talked about that they're going to grow this year approximately 36% year over year. Now, the business, it's led by acquisitions, okay? And this is something that I'm going to come into in a moment. But essentially, they're going to be lowballing that estimate to give themselves plenty of wiggle room to surprise the street as the quarters progress. But I think that for us to kind of talk about here, we're looking at a business that's probably growing at about 40% year over year, okay? So this is the number we need to keep in mind. So what does it actually do, okay? So it's become really the go-to platform. If you want to get pertinent, up-to-date, relevant, accurate information on a business or on an organization, you're going to go to ZoomInfo, okay? And essentially, it just becomes an ability to get granular information on department data. If you want to know who do I need to contact, or which professional, or which department, or who's raising funding, or whatever, if you want that level of information, you're not going to get it elsewhere. It's just going to take too long. So you might as well just pay up. And, that's what they do. And they provide that service, and customers love it. You see here, so net retention rate for the quarter just reported was 116%, up from 108% in the same period a year ago. Remember, that figure that you want to look out for is the 120%. When you hit 120% net retention rates, investors typically find that is really, like the gold standard. So in SaaS businesses, if you get 120%, it's like, yep, tick, done, on to the next thing. So it's very close to that. The number of customers spending more than 100K last year was 850. And this year it's risen to 1,450. So it's a jump of approximately 70% year over year. So clearly they're doing the right thing. Yeah? If you're getting customers spending more and more and more and more year over year, that's really all the insight you need. I've always said, follow the customer knows best. You don't need to get bogged down in quarterly results, just follow the customer. Profit margins are really, really attractive, but let me just kind of caveat that for a second, okay? Here's the thing. During the past year, ZoomInfo spent approximately 700 million on acquisitions. They bought a few businesses, okay? I think it was 3. Chorus was the big one, but there were some other ones there, okay? Now, this has led to its balance sheet going from approximately 1.9x net debt to adjusted EBITDA to 2.9, okay? So approximately, you don't want to be paying much more than, you don't want to be getting involved in a business that has higher than 3x net debt to EBITDA, okay? They know that, management knows this, you know this, everyone knows this, so it's like they're not going to be doing this as much going forward, it's just not worthwhile. They're going to pay down this debt and they're going to digest those acquisitions, and this is probably the high end of what it's going to go at. But just wanted something to highlight that. The other thing that I think is worthwhile discussing is management spends a lot of time discussing our unlevered free cash flow is like this, that, the other, okay? Unlevered free cash flow means that they're adding back the interest expense, okay? Now, if you're leveraging up your balance sheet and you're going into an environment where interest rates are rising, unlevered free cash flow is not an accurate representation of what the business is capable of doing, okay? I have used a very conservative measure here. I said that the interest expense is going to be approximately 50 million, so I've kind of assumed that if we take their figure of 2022 and we adjust for the interest expense, you're reaching approximately 380 million of free cash flow in 2022, okay? So that's the figure you want to anchor around, okay? Maybe you want to pause the video, think about that. 380 million of free cash flow is what the business is able to do going forward over the next 12 months, okay? Now, that puts a stock price at approximately 55 times forward sales. So forward free cash flow. This is the clean free cash flow. But if you think about how sticky this business model is, you think about the fact that you're having customers spending more than 100K, up 70% year over year, and the business is clearly still growing. As I said, that figure, approximately 40% year over year is the growth rate. They're not working towards maximizing free cash flow. This is like way down the road. So it's clearly growing and it's generating ample free cash flow. So all that considered, I think that there is really, a lot here to like about the business. Now, a few things. Obviously, it's a leader. I haven't highlighted the G2 report. I haven't talked about the Gartner report. I haven't talked about any of those. You can investigate that in your own time. But I just think it's quite insightful because when you think about it, if you're getting about 40% free cash, 40% growth on the top line, paying approximately 55 times free cash flow isn't that expensive. If you were to think about, it doesn't need a lot of capex, this business, what you see is what you get. So I'm just thinking to myself here that if it was any cheaper than that, you'd start thinking, okay, there's something wrong with it, I'm missing something. So I think that it's kind of like in that sweet spot. You don't want to be paying too much, you want to leave yourself some wiggle room. But here, the thesis is just the business continuing to execute as it does. You're not looking for a multiple expansion, you're just looking for the business to continue to grow at this pace, approximately 40%, and that's where your return is going to come over time. It's not really from the multiple expanding further. That's not what's at play here. But, so there's a lot to like here. This is not the type of business that I normally look out to buy because I normally like to buy things with a few more hairs on them. So if you want to find out what kind of names I'm particularly bullish about right now, don't forget to check out my marketplace, okay? It's called Deep Value Returns, right there above the screen. Check out what other people said. Check out the reviews. Come on board, drop me a line. I help you by providing you with high quality, actionable investment insights, okay? Thank you so much for listening. Bye-bye.